One more sip of coffee. Spoonful of coffee makes the medicine go down. All right, hey, good morning. How are you today? My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that allows you to trade Forex, energies, metals, indices, and binary options. This is your daily Forex trading strategy session for Wednesday. Can you believe it? September 9th, 2015. We're going to do a little dollar, a little yen, and all those good things. Let's get going, huh? Trade your way at Trader's Way with Traders Wayne. Hey, trading's risky. You might lose money, past performance, good or bad, not indicative of future results. Stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Don't touch the stove, you might get burned. Don't step outside, the sky might fall. All right, so how's your trading been today? Yep, Marina's got the pound. She loves the pound crosses. Yeah, some lame-o UK news today. You know, and the thing about that is this is exactly why you don't chase price around. Right? If you're a bull waiting for bullish setups. If you're a bear waiting for bearish setups. Well, that's not the one I wanted. Come on, after all that wait. And you don't chase price around. So yesterday we were actually pretty bullish on the British pound on the longer term. Cool. And then what happened? The dollar got strong. All right, put an end to that. Now, ideally, what you're doing is the whole time you're waiting for your turn. So if you were a bear, yesterday wasn't your day on the British pound, but today is your day. Versus running around like a chicken with its head cut off, making a bloody mess of everything. So what is it that we do? Well, what we do is we set up ambushes and we trade on our own terms when we have an unfair advantage, right? Kenny was trading copper yesterday. Sounds pretty good. Is copper going up or down, Kenny? Boy, look at this. What's going on? The MT4 is so unbelievably slow. I have 8 cores. What, is 8 cores not enough? What's going on, man? Oh, yeah? Scrap dealer, huh? All right, well, I'm trying to get this. I don't know why everything's so slow today. Let me move this around. Like, why was that moved? All right, so let's take a look at what happened. Let's use a 15-minute chart. Kind of looks up today. What do you think? So what did we talk about yesterday? I think it was yesterday. What might have we talked about yesterday in regards to risk on, risk off, the direction of the stock market? I think we specifically talked about the direction of the stock market and the value of the Japanese yen. What kind of relationship does the Japanese yen have with the Nikkei? Hmm? Right. So the Nikkei and the yen tend to move in opposite directions. You could look at this and trade dollar yen specifically under current market conditions. And that's because money is moving around. So recently we had some risk off. Now we're more risk on. And it all started with the Nikkei. The Nikkei was up big time today. Did that carry on into the European session? Well, that looks up, doesn't it? That's a 30-minute chart. How about the FTSE? I know, I have to clean this up. Seems like the FTSE was up too, wasn't it? So is it a risk on or risk off day? All right, so what do you tend to do on risk on days? What currencies should you buy? Long anything with the Japanese yen on it. So basically buy dollars, sell yen. It's one way of looking at it. Now, why buy dollar? Why sell yen? Well, the Japanese yen, for example, is a funding currency. It's cheap to borrow. It's not likely to appreciate much in value. Why not? Because the government is, and specifically the central bank of Japan, has a policy that tends to weaken the Japanese yen. So if it did get strong, right, the BOJ would probably come in and make it weak. So let's see, euro is stronger than yen, dollar is stronger than yen, Aussie is stronger than yen, pound is stronger than yen, CAD is stronger than yen, Kiwi is stronger than yen. Enough said? Now, did anybody fall prey to not paying attention to the intermarket? Did you sit down and just look for a trade before doing like analysis of what's going on around the world? Does anybody fall prey to that? Sit down, open your chart, have it tell you what to do and not look at things like what the stock market's doing? No, everyone's good. Right on. Everybody's good, huh? So, what is the reason for moving money around the world? Because remember, if money doesn't cross a border, currency valuations will not change. So what we do has to do with money flowing around the world, global money flow. What tends to move this flow of money? What is the catalyst? And it's usually greed or fear, risk on, risk off, right? Yield, safety. And, we're in prime time. I mean, I can't tell you how many times I've prepared you for now. The markets are moving big time, and these should be relatively straightforward trades. So, for example, on a risk-on day, who the hell would buy the euro? Over the last 3 weeks, the euro has appreciated at times. What was my explanation for why the euro appreciated at these times? Yeah, just short covering is the only reason, in my opinion, that the euro gets strong. So, I guess we don't need a 1 minute. So easy to get sucked into chasing price around. But I'd rather you, if you're a bear on this, sell at resistance, right? That's pretty much it. Right. So interesting, huh? The top of the market yesterday was the London Open. Top of the market today, again, London Open. You can see there's a little spike in there, but really it's this, isn't it? Right? But I do want you to trade in a direction. I want you to be able to say what you do. I want you to know what you do, for example. I want you to be able to explain it to a friend. And you can't just say, well, I sit down and I throw a bunch of trades around and I really don't know what I do every day. It just, sometimes I'm buying, sometimes I'm selling. I don't, it all depends. Right? Over the summer, I asked everybody multiple times to sit down and take the opportunity, since the summer can be quiet, and do some fundamental analysis, do some longer term technical analysis, and come up with a 6, 12, and 18 month overview for the currencies. Like, create a bias. What is the Euro USD going to do over the next 6 months? Right? Do you think that would be helpful in a situation like this? If you were to work at a hedge fund or a bank and they're interviewing you, do you think they would ask you that? Like, what do you think the dollar's going to do? And you're like, well, what time period? You're like, any time period. Just talk and sound intelligent. right? Just say something. Say something, I'm giving up on you. Right? So, challenge yourself. What is it that you do? What's your role in life? Hey, on a risk on day, I'm going to get short Euro USD. Okay, that's all. And then look, the little more advanced angle of things is to then pay attention to the intermarket, right? But I think I've been preparing you for risk on starting now, right? Right? Haven't we been waiting for the September NFP and all that kind of stuff to pass? And this is a big week. So let's start with USD yen. Felipe, you open up a stock market, for example. Nikkei. How much was the Nikkei up yesterday, guys? Or today? It's actually today, depending on where you live in the world. 7%? Okay. Is that significant for a stock market to go up 7%? Like, that's a good month, isn't it? All right. Now, do you think it's a coincidence that it's happening now, even though we just talked about it all summer for the last 2 or 3 weeks? Traders come back from vacation and they want to get serious and they got to wait for the NFP thing to get going. I mean, is this just a random occurrence, a random walk, a lucky again scenario? Or are you prepared for this? Or how about, let's change it. Have I prepared you for it? I'm trying to click all the pieces because sometimes you're too close, right? All you see is bark, and I have to pull you all the way back and say, no, there's a forest. Okay. Well, Felipe, what is a safe investment, Felipe? Stocks or bonds? Okay. So if stocks go up, is that risk on or risk off? So bonds are safe, but putting money into the stock market is risk off? Is risk safe? I mean, well, let's clarify it. Is risk safe? When I say let's do something risky with our money, does that mean put it in a bank account? Right? No, don't guess. Right? This is why it's good to ask questions, guys, right? Think about it. Is risky safe? Risk and safe are opposites. Okay? Risk and safety. So stocks are risky because they don't guarantee you anything, do they? What guarantee do you get when you buy one share of a company? You're guaranteed you own one share of the company. That's that. Safety would be a bond. A bond is a loan to a government or a corporation. They have to pay you back. And you know when they're going to pay you back, and you know how much interest you're going to earn. If they don't pay you back, they default, and they're really in a serious world of hurt. Because no one will ever lend the money again. So generally speaking, a default can and does happen, especially on riskier investments. But that's why you'll also know how risky the bond is by the rating agencies and all that kind of stuff. But if you buy a government bond, it's 100% risk-free because they can always just print more money and give you that. But okay, so a bond is safe. You're guaranteed to get your money back, or the issuing entity is in serious trouble. So you're going to get your money back. They will pay you interest. They'll pay you back on time. So it's safe. But what if the company doubles in value? Does your bond double in value? No. It was simply a loan. That's all a bond is. Okay? So that's safe. Okay? Let's say on a risk-off day, one of the safest investments in the entire world is loaning money to the Japanese government. JGBs, Japanese government bonds. A risk-free investment is considered U.S. Treasuries. So you could buy, usually it's short-term, notes and stuff and bills. So you could buy a 3-month, 6-month, 1-year bond. Okay? Now, the other interesting thing about the U.S. economy, the Japanese economy, the UK and European economies, is that they do have mature bond markets. So what if I bought a 2-year bond, but then decide 1 year later, I don't want the bond, I'd rather own some stock? Do I have to own the Treasury all the way to maturity? Okay. I can sell it. So it's actually a liquid asset. And, the interesting part is your bond actually can appreciate. Bond prices do go up. So let's say I own a 10-year T-note. Okay? It's 2006, and I own a 10-year T-note, and it's paying me 6.5%. Do you guys remember all that? I miss those days. I used to make like $5,000 a month interest on my PayPal account. Interest, man. Do you guys remember that? Isn't that crazy? Remember those days? All right. So let's say, you owned this 10-year T-note in 2006. You just bought it. Nice, issued, brand new 10-year T-note issued by the Treasury. And it pays, 6.5%, whatever it was, good money. Well, by 2010, what is the yield on the 10-year T-note if you bought a brand new bond in 2010? What's it paying? $1.5. So now I have a 10-year T-note. You have a 10-year T-note. I bought my 10-year T-note in 2006. You bought your 10-year T-note in 2010, 4 years later. Mine pays 6.5%. Yours pays 1.5%. Which one is worth more? They both have a face value of $1,000, but I can sell mine for more than yours. Someone will be willing to pay it because they'll earn the highest interest rate. So that's an interesting quirk, okay? So that's an important thing. Now, Japan has a very old, mature bond market. The United States has a very old, mature bond market, so on and so forth, but that's why they're majors. Okay? If you bought your government bond from the Central Republic of Congo, a little less liquid. Okay? So that's considered a very safe play when you're saying, I'm going to park my money in something safe and guaranteed and stable. Okay? But where's the room? Where do you get money? How can you put your money to work so that it earns more return? You could do something instead of loaning the government. Let's say you have $10,000. Instead of loaning it to the government, and so right now you buy a U.S. Treasury 10-year T note, pays what? 2.2, 2.1, depending on the day. All right. You can lend it to the government for 2.2%, and it'd be quite liquid. You could get rid of it if you needed to. But what if you lent money to a Fortune 500 company in the United States that's issuing a bond? What does a corporate bond pay? Let's say an investment grade, safe corporate bond. What would they pay? Four and a half, right? 3.5, depending on the corporation, right? Well, why do different corporations pay different rates? But also, why are those rates higher than U.S. government debt? Because it's the same thing. You loan money to the government or you loan money to a corporation, and various corporations have different interest rates. Why? Because of risk, okay? But you still own an asset. You still are guaranteed a yield. You are still guaranteed to be paid on time. Guaranteed in the sense that it's a contract. I mean, right? That's why I say that's why I say guaranteed. But of course, there are risks that the counterparty, in this case, the corporation, doesn't live up to its end of the bargain. Fine. So you don't face that from the government, because even if the government ran out of money, it could do a couple of things. One, it could just print money if it wanted to. But what can a government do that a corporation can't do if the government runs out of money? Borrow more. You have to raise the debt ceiling. Okay, what else could they do? Now, theoretically, a corporation can just issue more bonds too, right? Taxes. Thank you, John. They can just raise taxes. It's like, can a corporation just say, well, we'll just double our income from our customers, right? Only to a point, right? What if the cable company ran out of money and then you get a bill one day and it says, yeah, instead of $150 a month, it's $500 a month? What happens to cable subscribers? Goodbye. You're going to find an alternative as a consumer, right? But a government can just raise taxes. What if you stop paying the government taxes? You're like, what if the government just raised it to 75, like I think France, right? Didn't France want to raise taxes to 75%? Oh boy. What would happen if you're like, I refuse? That is just silly. I didn't vote for you. I don't have to pay these taxes. 75% is outrageous. Well, they do the first thing they do is they take all your assets, liquidate them, and just take them from you. Okay? And then two, they throw you in jail. Well, that's convenient, isn't it? So anyway, so a government is, when you loan the money to the government is considered risk-free because they can get the money, honey. And then two, corporations are riskier than the government, so they do pay more because risk needs to be compensated. And then various companies have different risks as well. A company that's only been around 5 years could be riskier than someone that's been around for 50 years, but obviously not always the case, but you get the idea. You can lend General Electric money for 1 week, right? Would anyone here be worried about lending General Electric money for a week or a month? Okay, you see what I mean? So you can see that return is a function of risk. So that's the bond market in general. But what if you wanted to earn potentially more than that? Than 2, 3, 4%. Because you can get that and you're generally guaranteed unless the company that you invest in defaults. Shouldn't occur very often in an investment grade bond. Okay, you can get junk bonds and stuff. They'll pay you more, but you're taking on a lot more risk, right? Or let's say instead of lending money to the company, what if you just invested into the company? Or to say it differently, became an owner in the company. Instead of a lender to the company, you simply became an owner of the company. And that's what the stock market is. Yeah, you might get access to dividends, which is an income stream, kind of like profit sharing. And owners get certain earnings per share, right? A dividend. You might earn a 3-cent dividend for every 1 share you own. And this can add up. I remember back in my early VC days, I was talking to someone that was a patent owner, and they were telling me a story where Microsoft just sent them like $75,000 in dividends. And that was like the first time Microsoft, I think, issued a dividend, but all of a sudden it was just like a ton of money. It just showed up one day. They're like, yeah, we're going to issue dividends. Here's a one-time thing. So it can happen. It's profit sharing. So anyways, you can buy a share in a company, and that's what a stock is, right? A part ownership. Then the more shares you buy, the more you own. You can buy enough shares to even sit on the board. Can you imagine? You own enough shares that you control enough votes that you can actually sit on the board of directors because you own so much of the company? Yeah, this activist investors do this. So, but that's a riskier thing, owning a company, because you're not really guaranteed anything. Yeah, you might get some dividends, but if you paid $50 a share and you're earning 3 cents dividends, like, wow, who cares? 3 cents on your $50. So the way that you make money is it has to appreciate in value, okay? Well, this is a lot riskier because you're not really guaranteed anything. So you need the market to go up. You need the company to perform well relative to its peers, and then it goes up. But also the way that it's structured, it depends on how many shares have been issued and whether they're going to issue more shares and dilute you out. And all these things have to come together when you invest into the stock market. So stocks are riskier than bonds. But stocks can appreciate with unlimited upside. The company could double, and then the company could double again. I'll give you two examples. I bought Apple at $6 a share, and I sold my Apple shares the day after I found out Steve Jobs died. So I think I paid $6 a share, and I sold it for like $450 a share. So that wasn't that long ago. I bought Bank of America at $5 and sold it for $15. Just a 300% return on investment. You're not going to get that from a bond, are you? No, you're going to get your 4.5%. That's it. So, but the value of the stock could go to zero too, right? So return is a function of risk. So, long story short here, when I'm asking you, is it risk on or risk off? I'll look at the stock market, and we did it very quickly, so I'm glad you asked because, this needs to be said. I look at the Nikkei, and Nikkei's up, boom, risk on, I sell all the yens, done. Right? Well, Felipe, you asked detailed questions, and it still wasn't clear, so I had to give you the 10-minute version because I want you to know. I can just tell you, you do this, do that. I want you to know. Yeah, and there's many other people that may not also know. Yeah. So again, if the world wants a high return and they're willing to take the risk for it, they invest into the stock market goes up, but to buy the stock, they had to use cash. To use the cash, they had to sell their assets. What assets did they hold that they could sell? The bond market. So if they're holding bonds, they have to be able to sell those bonds early, because you might buy a 2-year note for lending money to the U.S. government, but you don't want to wait till maturity to get your money back. You just want to sell it today. So you sell your bond to raise the cash to buy the stock market. And then, of course, many investors around the world also want to invest into the U.S. stock market. Why? Well, one, it's a very large stock market. Two, it has many of the corporations that everybody is familiar with there. Right? But three, it's actually doing well. The corporations here are performing well. They're hiring employees. They're earning a profit. They're issuing dividends. The future looks good. And the central bank that has a dual mandate to oversee the health of the economy is actually concerned the economy is too good for where current monetary policy is. So they're going to have to change current monetary policy to reflect a positive outlook for the near and medium future. You see what I mean? Okay, good. A nice follow-up question. Is it the Nikkei Japanese stock market? Yes. Okay, so let's get deeper then. This means that there's an inverted relationship between Nikkei and yen. Currently, yes. When the Nikkei goes up, the Japanese yen goes down. Yes. Why? Well, first of all, JGBs are falling. That's the assumption. They're getting out of their safe investments. And some of that money is going into the Japanese stock market. Up 7%. Somebody bought it. But when you go to cash, when you sell your bonds, which are just simply better than holding putting it in the bank account, right? If you put it in the bank account, let's say you have $1 billion and you put it in the bank account overnight, how much interest are you going to earn? Well, 1 day's worth of 0.5%. But right? But what if you bought just for overnight? You bought an overnight one that did pay you 1%. Well, on $1 billion it matters. Okay. So anyway, so now you sell your bond and you go to cash. Some of it went to the Nikkei. Oh, some of it went to the Nikkei. But is it possible that Japanese investors also invested in other places like, I don't know, the United States stock market? And the answer is yes. So to do that, Japanese investors need to sell their Japanese yen. And this is exactly where we make our money, guys. This is called the foreign exchange market. They need to go to the foreign exchange market and say, yen for sale, 120 yen for sale. Someone says, hey, I'll give you $1 for that, huh? They're exchanging that money now in the foreign exchange market for some other asset, some other cash. So a Japanese investor goes to the foreign exchange market, says, all right, for just over 120 yen, I can buy $1. So they buy dollars, but they're selling yen. Once they hold the dollars, then they can spend the dollar on things like shares in a U.S. corporation. Now that they own dollars, they can buy Google. They can buy Apple. They can buy Bank of America. They can buy the S&P 500. Oh, they could buy a treasury too, but they already had a treasury. They could be buying treasuries, but more likely they're putting it into a riskier asset. So they buy the U.S. stock market, but they had to first they had to dump their JGB and go to cash in yen. Then they had to go to the foreign exchange market, sell their yen to buy dollars, and once they have the dollars, they had to convert the dollars into because cash doesn't do anything. How much interest rate does your cash pay you? Nothing. If it's in a checking account, it does nothing. If it's under your bed, it does nothing. You have to convert it to something, right? It's a medium of exchange, a unit of accounting, right? A unit of account, a medium of exchange. I mean, it's a store of value, but even that can lose value through inflation. So you got to convert it to a performing asset, and that might be simply owning S&P 500 futures. Okay, so that's that process of safety to risk, and then to exchange it in the foreign exchange market, to then converting it to a performing asset. Yeah, it's risky investing into places like the United States and buying a stock. There are lots of risks associated with that, but today we're risk on. They're taking the risk. Now, if you're in the foreign exchange market trying to sell your Japanese yen, what does that do for the value of the Japanese yen? Because if you're selling, that means the supply of Japanese yen goes up. You're adding to the availability of Japanese yen. So you're more yen. You come in, you want to put in 1,000,000 yen, but there's some other people in Japan that also want to put in 1,000,000 yen and do something with it. Selling yen to buy something else. Now, it could be British pounds they want to buy. It could be Aussie dollars they want to buy. It could be, well, no one wants to buy euro. But you see what I mean? So the supply of yen goes up, and the demand for other things goes up. So that when demand goes up, prices rise. When supply goes up, prices fall. And thus, the Japanese yen, on a risk-on day, in current market conditions, tends to weaken. Oscar, you may ask a question. It's why we're here. But Felipe, I hope that answers your question. Okay, Oscar, why would you buy gold? Good, Felipe. Joseph says very detailed. Yeah, cool. No, well, Oscar, you have to answer the question. Why would you buy it? Yeah, no, but you should be able to. It's a basic question. Why would you buy it? On a risk-off mode? Sure. If you're worried about systemic risk where the financial market is not going to function, gold would be a fantastic opportunity to buy. Okay. Now, some people buy gold because they use it in dentistry. Some people buy gold because they use it in electronics. Some people buy gold because they use it in jewelry. Isn't it better than buying yen? Why would it be better? And I'm not getting all pissy. I mean, honestly, like, why would you say it's better? Right? It's just an open dialogue. So if I buy JGBs, the government's going to pay me money and guarantee my money comes back. I can't lose. Now, there are some risks, as we know. Interest rates could change and exchange rates can change. But generally speaking, I own that piece of paper. They will pay me back, and I will earn an interest. Okay, so why is gold better than that? Well, yeah, that's the question. So again, you're asking, so why don't they buy gold? Well, why would you buy gold? I'm asking you. So I could buy a JGB. It's perfectly safe. I cannot lose money, and they will pay me an interest rate. Gold could go up or down, doesn't pay me an interest rate. And in fact, if I'm holding physical gold now, I mean, I can actually physically hold a bond, right? I just shove it in a file in my desk. But if I own gold, now I have to store it somewhere. So now I have carrying costs. Okay? George says it's less liquid. It's true. Gold is a store of value, and it can be converted into cash, and then cash converted into something else. But at least in the United States, you can't really walk around with a suitcase full of, gold bullion. You can in Dubai, right? You still have to convert it, right? I can't go to the grocery store and, with a gold ingot, buy some bread, some milk, some eggs, go to the cash register, and then put down a gold ingot, right? They can't do that. So it's Now, Japanese government bond, how long will it take me to sell the Japanese government bond in the Japanese bond market? A millionth of 1 second. Yeah. Nanoseconds. Okay. So gold, Oscar, is great if you're going to use it. But to have it sit somewhere, usually what you have to do is you have to put it in a vault somewhere and then pay them rent. Okay? That's called a carrying charge. And then when you do want to sell it, you probably need a broker, and they're going to charge you money for the transaction. Okay? It doesn't pay you an interest rate. And the value of gold could drop significantly, right? What are the chances gold could drop $1,000 an ounce? Almost none. What's the chances that gold can drop $100 an ounce? Well, pretty good, actually. Now, it could also go up $100. Okay? But there's some uncertainty there, and that is called risk. So when you look at gold and when you look at a bond, the gold is riskier. And that's okay. But if the financial system crashed, okay, Oscar, that's different than having a risk-off day, profit taking and all that kind of stuff. If it was the end of the world, if capitalism was on the brink of failure, yeah, gold would be cool. Okay? But that's the part where most people are missing. Okay? But if you were a billionaire, how many hedge fund managers do you think are trying to knock on your door? Oscar, lend us your money. Oscar, give us your money. Oscar, we're so good at investing, give us your money. They're lined up around the corner. All right? How many are pitching gold ideas? None. Gold is dead. There's no reason for it to significantly appreciate. The risk is to the downside, but there's no real reason for it to depreciate. So gold for the last 2 or 3 years, I mean, it's of no interest to anybody except the people that use it. Felipe is saying, what if Nikkei is just down for the day? Is that risk off? Yes. So we trade in a highly efficient market. And what that means is all known information is priced in real time. So why did the stock market fall in Japan? Let's say you say the Nikkei is down for the day. Let's talk about the mechanics now. Okay? How do you get the stock market to fall? There's 2 ways. Give me one. No, I mean mechanically. Excuse me, mechanically. What do you actually have to do? Not why. Okay? One would be sell stocks. And what would be the other one? Take profit on what you own. One would be like short selling, and one would be profit taking, which is similar but different. Okay? So there's selling pressure. The vast majority of it, of course, is really just profit taking, right? What percentage of the market do you actually think short sells? Very little. Okay? So if you bought the Nikkei last year and now you're worried that it's all done, you cash out. All right, so you go to cash. What do you do with the cash? Stick in a bank account? No, you shouldn't, not if you're a billionaire. See, here's the interesting thing. You buy a bond. If you think the stock market's going to crash for a year or two, you buy a bond today, and what if the stock market's down tomorrow, and the next day, and the next day, and more people keep getting out of the stock market? What are they doing with their money? You bought bonds on Monday, now it's Wednesday, and it's been down all day Monday, all day Tuesday, all day Wednesday. More and more investors are getting out of the stock market. What are they doing on Tuesday and Wednesday with their cash? They are also buying bonds. So demand for bonds is going up. What happens when demand for an asset increases? What happens to price? price increases. So now bonds on Monday are now worth more than the bonds that are being sold on Wednesday. So you're actually making money there. And then what happens to the interest rate when prices go up? Goes down. So the bond itself, you could sell for more money than you paid for it. That's called appreciation, right? And interest rates are falling as more and more people are buying, prices are going higher, and interest rates are getting lower. And that's how a central bank actually works. If you like this conversation and this kind of, if you like everything about it, you should consider the fundamentals course. Yeah, training.fxbootcamp.com. Well, yeah, Casey, contact me and let's you got to figure it out, or we'll try some other things. Okay, so that's the mechanics of it. So even if you're just down today, well, they're not just colors on a screen. Somebody sold their holdings in the equity market, and they most likely converted that cash into a bond. Again, there's an inverse relationship. If stocks fall today, that's risk off, right? Bonds go up today, also risk off. And if they're risk off, there's fear. Okay? So imagine now you're a Japanese and you put money all around the world and you're like, whoa, man, I feel like risk off. So you're like, give me my money back from the UK, give me my money back from the Eurozone, give me my money back from Australia, give me my money back from the United States, and it all flows back to Japan because those are all risky investments, and they put them in Japanese government bonds. So what happens? The supply of British pound, the supply of euro, the supply of Aussie dollar, the supply of US dollar all goes up in the market. Because they sold those assets to buy yen, so therefore the demand for yen goes up and the value of the yen goes up. And then they buy JGBs, so that the value of JGBs goes up and interest rates fall. Does that make sense? That's the mechanics of it. Isn't that cool? So by and large, and I want you to understand this, or at least hear me so that you can go out and do your own research. By and large, what we do is bond trading. A value of a currency can appreciate when demand for those bonds goes up, or when the demand for those bonds goes down, the value of the currency can fall. Or demand for other assets. So in the United States, the interest rates are incredibly low, but not relative to other countries. So there might be some interest there. But also, what's the outlook for the future? If you want to own an asset for 5 years, the United States might actually be pretty good. Or if you wanted to own shares of a company, over the next 5 years, things could possibly be pretty good. Or if you wanted to buy a factory or a skyscraper, okay? Money is going to flow to the United States, isn't it? And as long as it's flowing to the United States, demand for the currency is going to be high, and therefore the valuation of that currency is likely to appreciate. All right, I've lost my mouse. Hello, mousy, mousy, mouse. Oh, there it is. All right, finally found it. So yeah, risk on, man. Risk off. You should know what's going on. And now these correlations can and will change. So right now, the US dollar gets strong when the stock market tends to go up. There was a time when the US dollar was by far the strongest currency in the world, but not because it was a risk on mode, but because it was a risk off mode. Say what? Well, yeah, market sentiment changed. So when the end of the world for capitalism as we know it was upon us, what currencies got strong? Japanese yen, US dollar, Swiss franc, gold. That's when you buy gold. When you're like, I don't know about all these other assets, fiat currencies could disappear. But those currencies got strong because they were being converted either to cash in your Swiss bank account or into bonds in Japan and the United States. And if you think of every billionaire in Indonesia and Malaysia, when their economies were faltering and all the other economies around them were faltering, and it was the end of the world, end of capitalism as we know it, where did they decide to park their billions and billions in cash if you're a billionaire in these countries? Do you park it in a bank account in Malaysia? Oh, sure. German bonds are fine. Just look at the yields, right, John? Just look at the yields. I'll tell you everything. Yes, John, that's exactly right. So John says, I would expect euro to become stronger on risk off. That's exactly correct. So I started today's session, and it's probably a good way to end it. Over the last 5 or 6 weeks, there have been times when the euro's value appreciated. And I say, why? And it has nothing to do with the euro. No one actually wanted to own the euro. They were just getting out of the trades they were in. Okay? Another way of looking at it is on days the US stock market fell, European investors cashed out, converted their money to euro, and bought some German bunds with them. But do they actually want to earn the euro? Do they want to hold it? Was that the actual investment? No. It's just a risk-off day. So Demeter asked a question about the European migrants and would that affect the market? Blah 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 blah. It's all very interesting stuff on a humanitarian level, but in a financial level, doesn't mean a thing. You got to separate yourself from the news and from money. So do you guys remember when the United States was sending aircraft carriers to sit between Japan and Chinese aircraft carriers, and we were doing this big dance over some islands in the middle of the Pacific somewhere? Do you remember all that nonsense? It's probably still a big deal to Japanese and to the Chinese, but it was on TV here for a while, right? And it was on the news all the time, all the time. Oh, there's going to be a nuclear war. Do you guys remember all that? George, it's both. Okay? So, did it actually matter to the market? No, it didn't. And somebody asked me at that time, because we were at the brink of nuclear war, according to CNN and Fox News, and they asked, what should we do? Will it, and my answer was, if missiles are flying, if missiles are in the air, yeah, buy some gold. But the rest of the financial world only cares about making money or not losing money. The rest is just fodder and distraction. So the migrant situation in Europe, hugely important on a humanitarian level. I'm sure the IMF and the World Bank want to get involved. But as far as, us making money today, not a big deal. But peace on earth. May the pips be with you. May your profits be above average. Good fundies conversation today, guys. Yeah. And if you want the course, remember TradersWay.com offers you 51% off by sponsoring you. Do you know how to earn a $500 discount, guys? Put $500 into a TradersWay account. That's it. They'll give you a coupon code. So you either give me the $500, but why would you do that? Put the $500 into a trading account and get the discount. And now you trade the $500 and turn it into money. So thank you, TradersWay.com. Yeah. So again, the world needs to hear it. Peace on earth. May the pips be with you. May your profits be above average. Cheers.